So here's what we're going to do, Brett. Here's what I want us to do. We're looking at the 10 companies here. A year from now, I want to see who wins. And I think you should pick a company and I'll pick a company. And we'll get together a year from now, assuming they're still letting us do these videos, and we'll see who wins.
So I would start off with, I think most clients would look at this, and if this was in their portfolio, they'd look at it and say, well, JP Morgan Chase did the best over the last few years, and so I want to own more of that, and I want less of Verizon. So I'm going to take the exact flip side of that. I'm going to take Verizon, which I think had the worst performance on that chart.
I'm going to play off the momentum, and I'm going to say, and again, this probably has nothing to do with anything, with rates going up next year, Brett, when interest rates go up, what segment of the economy benefits when rates go up?
Financials.
Financials, baby. Give me JP Morgan, give me Jamie Dimon over the next 12 months against your Verizon.
And Mr. Mrs. Viewer of this video, I will say two things here. Number one, congratulations to Marcos, who won fair and square. That's first. Number two, though, I believe if we were to watch the video, we would clearly have heard you say the reason you thought that JP Morgan would win was because rates were going to go up.
Yes.
Rates went up for the entire year.
Yes.
And for the first 9 months, that theory held no water whatsoever.
Are you kidding me? Have you heard of lagging results?
Oh, so it only the last 2 rate increases helped.
Absolutely. Because the tide came out, which is a macro risk or systemic risk for those who are caught up on their macroeconomic textbooks. Systemic risk took down JP Morgan like the rest of them. And then once the tide was out, you got to see the quality of businesses and Jamie Dimon for the win.
You should write books. That's a great story.
Jamie Dimon for the win. Yeah, it'd be a short book. That'd be a short book.
In fairness, JP Morgan only ended up 1 slot above Verizon.
Oh, that's so cute.
So
That's
I'm not
so
really
cute.
sure you should get that much credit.
Are you really doing the hand grades and horseshoes thing, buddy? This is a zero-sum game. Boom. What we should do is bet like $500, and then the spread as a percentage of $500 is what the other has to pay to the other.
I'm not going to put $500 on a company that I have no care less about.
No. So here's an example. Here's what would happen. What was the ultimate performance?
7.5% difference. So.
That was the difference. So yeah, so just 7.5% of $500. 37.50, baby.
I'm not going to lose money trying to pick a dog.
You owe me 37.50.
I have to keep my money in my pocket.
Oh my gosh. You're just playing to the crowd here, dude. You're playing to your persona. Stop it. Buy me lunch. Buy me a nice lunch.
I'll buy you lunch anytime you want. Not because my dog or the Dow lost to yours. Not because you even picked.
That's fine. You can buy me lunch. I won't tell you it's because of this, but once we're done, I'll say thanks for taking the loss like a winner. Welcome to Talk Your Chart, episode 28, first recording of 2023. Welcome to the new year. We are recording on January 12th this year. CPI print is out. It's not a bad one, but more importantly, I won. JP Morgan won. Beat Verizon. Wasn't looking good for me for JP through October of last year, and a quick 2-month rally put me over the top. I'll take that W. We'll see what happens in 23. Brett, let's get things going. I believe you want to talk to us and the viewer about tech stocks.
Yeah, well, congrats on your victory, Marcos. Take your 1 day here to enjoy it, and we'll never talk about this day ever again.
Yes.
It was a good day for your stock last year, relatively. Still a down year for most stocks. And I think we had talked over the years about how much some of these FANG stocks, Facebook, Apple, Amazon, Netflix, Google, Facebook's now Meta, how much they had contributed to the percentage weighting of the market and how well they had done. And now here's the flip side. In 2022, they have done awful. So that is why you've seen the Dow Jones do a lot better than the S&P, because the Dow is not weighted as heavily in the stocks, and these companies just hit it on the chin. So even though they're good stocks, even though they're making a lot of money, you don't want to invest in one single stock, because a 50% loss means you need 100% just to make it back up.
Yep. This is a story of rates. Markets reprice quickly as soon as rates went up as high as they did. Interesting to note that earnings growth expectations rose last year. Wait, how does that make sense? Well, because all the decline was due to a shrinking market multiple ratio. Like, so the S&P multiple slid from 17 to 23. They pay less for a dollar of earnings, and that's what you get. You get a smaller representation of these long dated technology stocks. And yeah, Facebook apparently is really betting on artificial intelligence and the metaverse and all that stuff. So we'll see how that turns out.
Yeah, apparently there's not a lot of people in the metaverse right now. So maybe in our next episode, we can have an entire room free.
Real estate's on sale though, just bargain prices for a duplex in the metaverse.
Well, the one thing we have to be careful about saying, and we always tell our clients this, is just because a stock is down doesn't mean a stock has to bounce back, right? So you can't look at this and say, oh, Facebook guaranteed winner because it's down 64%.
Yeah, that's the problem. And this is also not to poo-poo on what Zuckerberg and that whole team is doing, right? That could be the future without a doubt. That just might be in 20 years. So we'll see how it performs. So speaking of tech, how about layoffs in tech? Right, you pulled this chart, which I thought was an awesome one. It shows the impact of job cuts on each company's overall workforce, but it gives you a relative change, which looks, again, it's kind of, I'll be honest with you, Brett, the part that is more telling is the meteoric rise from 2012 to 22. This is, I think, a perfect visual representation of investors and people at the helm sharpening their pencils and saying fundamentals matter, and appreciating what Elon Musk has just done and said, we probably could do the exact same thing as we're doing now with half the employees.
Well, yeah, I mean, Amazon's got to be larger than most cities in the country with that amount of people that's in there. And you mentioned in the past how these companies are laying off, but it's such a small percentage of A, the labor force, and B, of how much they had hired over the last few years. And if you look at the number of people that are being laid off, it seems like every one of them is finding a job within a few hours of leaving their old job.
Yeah, so that's the biggest thing. So layoffs are going up. Wage growth is showing like it's rolling over based on leading indicators for wage growth, and not just one, but a lot of them. The only thing that's telling is a lot of people that are getting fired are getting hired very quickly. So there's clearly still strength in the labor force. But I think, funny enough, one of the kind of the green shoots, I guess, silver linings, I have no idea. It's kind of weird because we're still living in this good news is bad news and bad news is good news world. The labor market slowing down is going to be good. People getting fired is going to be good, I guess. That kind of stinks. Sorry about that. But I think the story there is the Fed feels it has better tools for dealing with unemployment than it does for runaway inflation. We do not have runaway inflation, obviously, but it's just trying to make sure that we never get to that, because the pain to fix that problem is worse than the pain to fix the current problem.
Well, that's the question, though, is how much more pain will there be? Because every month we wait for higher unemployment figures because it's now bleeding over a little bit into financials. You're seeing some companies cut, and the Fed is, and most people seem to think that this is going to be a wider spread problem next year. But as we look at the next chart, unemployment is at a 50-year low, 3.5%. And it doesn't help when you've got a labor force participation that's still below where it was before COVID a few years ago. And so you got a lot, we talked about in the past, a lot of people have retired, stepped away for COVID, going back to school. So I just don't know how much is going to bleed into other areas and how much worse it's going to get.
Yeah, the labor force participation rate is interesting. If you zoomed out that chart to go back to the early 2000s, late 90s, you'd see a trend that shows the labor force participation rate ticking down since then. There are obviously forces that are beyond what's happened recently, but this has just kind of accelerated that trend, with the obvious rebound coming from the over kind of sold position, so to speak, after COVID. I don't know how that gets fixed per se, given demographics, right? Like the working age population as a percentage of the US and as the world is kind of becoming smaller. So for those people that might still be considering having kids, do it. That would be helpful to the global economies. But does this also is this like a good thing? Demand for labor is strong. Is that good? Is that bad?
Well, it's hard when you're hiring. I mean, we've had huge hiring attitude in the last few years. We had 40 full-time people now. It's our largest count we've ever had. And it's been a challenge to hire people because there's not a lot of people out there. And everyone's looking for the same workers. So you've got a challenge finding the workers. You got a challenge then paying the workers. You're now paying them more than what you would have a few years ago. So I don't know what's going to change this and how or why we would expect the numbers to change radically, especially the participation rate from where they are, because it just doesn't seem like with the labor force where it is and so many jobs out there that you're going to have a huge influx of people saying, I'm going to go back to work when I wasn't working before.
Yeah, here's one thing that could impact it. Who knows? Because we've been talking about it. All the excess savings that everyone has. Yes, there's still some there. We've also seen consumer credit go up, right? We're not talking great financial crisis here, but yes, consumer credit is going up. People are still spending. It's hard to behaviorally break a lifestyle that you've enjoyed and say, oh, now we have to reel it in. That lifestyle creep is a real thing. Depending on where you look, some people think that it's going to be through the end of this year that people have excess savings. Some people think, AKA Jamie Dimon, that excess savings is going to be depleted by March, April of this year. If that happens, that might be beneficial to labor force participation because people on the sidelines might be coming in and people that were retired might unretire. The next chart, which is how bad was last year. It was the worst year for bonds, right? And why was it the worst year for bonds? Because there's really not a bunch of great data going back to the 1800s. But basically, you have to go back to the 1800s to see a bond period this bad. Why did it happen? Because the worst things that can happen to bonds happened. Inflation and rates going up incredibly quickly, high degree of magnitude, right? So big upswing, and it was done quickly. Literally worse at down 13%, looking at the Barclays aggregate. And then the seventh worst year ever for US stocks, which is, it was interesting because that you're literally telling me that last year was a top 10 crappy year for the US stock market. That's pretty incredible, right? Because it was bad, but everyone always thought it could get worse. Not saying that we're not going to retest the lows and maybe even surpass them. The market was down as much as 25%, I believe, on October 12th of last year. So we could retest that at the very least, if not do worse than that. But to know that it was seventh worst in history and you survived, probably, that might be a little bit of a win you take away from it.
Well, I would say so. If we're talking about things that someone should do to survive, I would suggest that, and we've talked to all of our clients about this, make sure you don't have too much risk in your portfolio. You know, you don't want to start the year with 80%, 90% stocks if you can't handle the downside, especially as a retiree.
Yeah.
You know, you want to make sure you've got the cash on hand to get through this, or at least sell as little as you can, because once you sell, you're locking in those losses. So if you've got cash on the sidelines, you've just retired, make sure you've got some amount of buffer in there to get through this period of time.
Yeah, exactly. I
And then-
think also,
Go ahead.
quick post-mortem. Take a little bit of a pulse on how you did behaviorally and emotionally in 2022. And maybe that 90% stock portfolio that you thought was right for you, maybe it's not so right for you. If you lost any sleep, if you got into a fight with your spouse, maybe have a conversation with the person who's managing that, whether that's you or a professional, and maybe reconsider what it would look like if you dialed down risk a bit, or maybe the other direction. But I think postmortems are always helpful.
Oh, yeah. And I think we do that well by going through and revisiting the financial plan and telling a client, what does this mean for you? Should you make a change? You know, I had a client come in the other day, and the end of the day, the result was stay the course. And she was thrilled to hear that, because it meant, oh my gosh, I went through this horrible event, market's down, I lost some money, but I don't have to change my life. I don't do anything differently. But she did want to know, if it did require a change, please tell me. I don't want to bury my head in the sand.
Yeah, precisely. Second chart here plays right into this. 60-40, Brett, how did it do last year, given those stats?
It's dead, right? 60-40 is dead. That's what we all hear now. Every time a 60-40 has a bad year, everyone says, well, you shouldn't have 60% in stocks, 40% in bonds. You should have something else, but we don't really know what that is. We just know that this didn't work.
Yeah, it's the benchmark portfolio, right? The 60-40. The requiem has been sung many a time. The funeral has been had many a time for the good old 60-40. Alternatives are having their day, and everyone's saying the new portfolio is really the 30, 20, right? Which puts 20% in these fancy alternatives, which have done good on a relative basis. I'll steal something from Lane Jones that says, don't put up the shutters during the storm or right after. So while we're always looking at different investments on behalf of our clients, we are never going to respond emotionally or in a chasing fashion, right? So is a 60-40 dead? I have no idea. Are public markets and capital markets dead? I highly doubt it.
60-40 is dead until the next time 60-40 is dead. And for the next
Yeah,
10 years, it'll probably work really, really well. I'm surprised that some of these numbers on the bottom, you're talking about, worst years, down 4.8, down 4.9 for 60-40. It's not so bad when you're talking about markets that typically get you 10% for stocks and 5% for bonds.
Yeah. I guess the only thing to couch all of this is these are calendar year returns.
Right.
So this is from the start of the year to the end of the year. If you see, for example, in 2022, that's how a 60-40 finished, which, man, that is bad. But appreciate the fact that throughout the year, you were down more at one point in time. There was a recovery from October 12th to the end of the year that padded that number a little bit. So that figure probably got as bad as 20 to 23%.
So let's end on a positive note here. We got a couple different charts that we're going to talk about.
All right.
The first one is that the PE ratio, price to earnings, how expensive the market is, has come down dramatically from 23 times to probably 17 you're looking at, just slightly above the average. And the average by no means it's above the average is going to drop. If it's below the average, is going to go up, because there are times where it's cheap and it goes cheaper, or times where it's expensive, it goes more expensive. But you're now at a reasonable level. And we look at put to call ratio. Puts are people that are basically protecting themselves, buying protection against the markets. That had spiked. And so maybe you take these two things as a sign that, hey, people are nervous, valuation is not that high. And so now's a great time to get in and, go against the tide of where everyone says, hey, I want to take chips off the table.
Yes. So I love the vol index because I have a point to make about that also. Real quick on the top part, the PE ratio. Like we said earlier, it was multiple contraction that killed markets last year, meaning the price that any investor is willing to pay for $1 of earnings and the S&P 500 went down. That's what happened. The big question now is, what are earnings actually going to do? At some point, you'd imagine, actually not at some point, it's already been priced in some level of earnings contraction. How much? I have no idea. I don't think you know either. If it gets worse than what market expects, yes, we are going to go a little bit lower before an ultimate recovery, but that's the big unknown.
It seems like the market is set for that, if this last chart is any indication of the probability that it will deliver some good returns.
Yeah, so look, this chart is just talking about what happens after down years, right? So let's, a couple kind of talking points into this chart. So when we look at this thing, right, since 1950, there are 19 instances of a down S&P year. In the following year, stocks are flat, which means within the range of down 5 to up 5, only 11% of the time. And stocks are up over 20%, 53% of the time. So after a down year, stocks are 5 times more likely to rise 20% than be flat. And more than half of the instances are greater than 20% gains. What do you think?
I'll take anything positive at this point.
Yeah, I know, dude.
Two
But
bad
it's
years in a
incredible.
row is not what I'm looking for.
Yeah.
But look, we had a year. We still have some things to be thankful for. We don't live in Ukraine. There could be a lot worse things that are going on. We've had a great time recording these episodes. We should probably thank Natalie and Veronica for editing and doing all the work in the background. And we're thrilled that we can keep doing it for another year.
Absolutely, as long as they let us.
And there's lots to talk about.
BH, there's always something to talk about. I love it. BH, I love you. You're a great partner to have in this. Veronica and Natalie, thank you.
Take care.